How does the stock market work? Let's go back to the 1600s. The Dutch East India Company sent ships across the world to trade spices, gold, and silk. These voyages were extremely expensive. So the company turned to individuals who were willing to support the trips financially. In exchange, they were offered a share of the company's profits. This allowed the company to plan costly voyages while increasing profits for both the shareholders and the company itself. These shares were sold in coffee houses and shipping ports across the globe. This is how the Dutch East India Company invented the world's first stock market. From then on, companies began collecting funds from investors to support and grow their businesses. Today, the stock market has grown so much that it has colleges, careers, and even entire social media platforms dedicated to understanding it. The modern stock market is far more complicated than it was in history. So, how are companies and investors using the market today? Let's consider a new cola-making company that decides to launch in the market. The company advertises itself to large investors. If investors believe the idea is good, they invest in the company and sponsor its IPO.
After that, the company is launched in the public market.
Now, anyone who understands and believes in the business can buy the company's shares. Those who buy the stocks become partial owners of the company, and their investment helps the company grow. As the company becomes more successful, more buyers see its potential and start buying its stocks. As demand for the stock increases, the stock price also rises, increasing the value for existing shareholders. For the company, this growing interest is beneficial, as it allows the company to invest in new projects, which further drives a higher market value. However, if the company becomes less profitable for any reason, the reverse effect occurs. For example, if contamination is found in one of the cola containers and the company shows no response, investors may believe the company will stop making profits. As a result, the stock value falls and investors sell their stocks to book profits early. As more stocks are sold, demand decreases, stock prices fall, and the company's value drops. This can leave investors with heavy losses until the stock appears profitable again. This constant seesaw of supply and demand is influenced by many market factors. Companies are under the unavoidable influence of market forces such as the prices of raw materials, changes in production technology, and the cost of labor. Other influences include changes in leadership, negative publicity, and new laws or government policies. Sometimes investors sell stocks simply to pursue their personal goals. All these factors cause day-to-day market changes, making companies appear more or less successful. A stock market that appears to be losing value often leads to a loss of investor confidence, which further reduces company value. Human emotions and confidence have the power to trigger everything from market booms to financial crises, and these emotions are difficult to track or predict. That is why professionals promote long-term investing over intraday trading for quick profits. Today, many technology companies create tools to predict market trends and increase the chances of success. But the stock market is not only for the rich and powerful. With the rise of the internet and easy-to-use apps, everyday investors can buy and sell stocks just like large investors. As more people educate themselves about this complex system, they can trade stocks, support businesses they believe in, and work toward their financial goals. The first step is getting invested. Invest and grow your wealth. Interested in learning more about the stock market? Follow this channel and subscribe.